Hi, I'm Martin Shkreli. This is the fourth installment of our investing series where I try to teach the basics of finance and investing. So welcome aboard. And we are going to be looking at IBM today. So I'm going to be paying attention to only this Yahoo Finance chat. We've kind of gotten rid of the blab idea. So let's see, if anyone has questions, you can just pop them into that chat and the moderators will deal with it accordingly, or I'll notice it and bring it up. So we're going to start by going to our SEC website, which is our favorite website, and it's just clicking the search button. This should be your bookmarked website if you're serious about investing. We're going to type the stock ticker of the company we're interested in, which is IBM, and we're going to start building a model for IBM's earnings and cash flow. So it's funny to me that their name stands for International Business Machines. So anyway, here's their income statement, and it should look familiar to you, similar to Apple's. All income statements are sort of the same. They start with revenue, and they sort of go on to costs, and then there's profit. So it's the basic structure of all income statements in business. So it's not totally different from they're all sort of the same in some ways. But what's interesting is the magnitude, right? We know Apple was doing, $75 billion for a quarter of sales. And let's save it here. And IBM last quarter did 19 billion in sales. So let's see, Q3 15. And they have three different kinds of revenue: services, sales, and financing. For total revenue is split up into three business components. And it's interesting that IBM is almost all services now. You can see that 12 billion out of the 19 billion is services. And we're just going to sum these to make sure they add up. Do a little formatting. Control-1 is the formatting shortcut. And so let's look at the costs to each business. Services cost. Is this keyboard too loud? I can try to fix that. The sales cost. Sales is really products, right? Think of that as products cost. Financing costs. And then finally, total costs of goods sold. So it's an interesting way to segment, and you can see the margin on each product line is different. In fact, if you kind of eyeball it, you'll sort of see that maybe should we just put it down here? Services gross margin, sales gross margin, financing gross margin. How do we do that? We'll see how that goes. So let's see, sales gross margin is 4.2 billion. So even though the bulk of the sales are coming from services, you can actually see that the product line is much more profitable. It's actually most of the profits are coming from the products. And the financing is pretty small. So total gross margin is, let's see, revenue minus total cost of goods sold, which is 9.4 billion, or just all the gross profit lines individually. So you can see IBM, for every $19 billion, so let's say it's about 50% gross margin, right? Let's do that. Gross profit instead of gross margin, although those are sort of the same. So we can see for IBM, their gross margins are about 49%. Does anyone remember what Apple's were? Apple's gross margins? Come on. %, yeah. So IBM kind of keeps 49 cents of every dollar, whereas Apple keeps 40. It's kind of interesting. They're not similar businesses at all, really. One is sort of a phone maker, more or less, and the other is a services sort of company. But we'll learn more about these individual companies shortly. All right. I don't know what I just did here, so just whatever it is, I don't like it. All right, here we go. So selling, general, administrative, 4.7 billion. Research and development, 1.2 billion. So operating, we call these operating expenses, right? Operating expenses. Operating income is gross profit minus operating expenses. So they have about 3.4 billion. So 19 billion in revenue and 3.4 billion is their final kind of operating profit for their business. We're not including interest or taxes yet. Sometimes call this EBITDA. That's how you pronounce it, EBITDA. Not EBITDA, but EBITDA. And it's earnings before interest, taxes, depreciation, and amortization. And sometimes it's just EBIT, earnings before interest and taxes. So that's sort of one way to think of operating income. But then we have interest income. In IBM's case, can have a variety of, just call other income. It's probably best. And there's a bunch of positives and negatives. So 188 plus 133 minus 117. So they sort of got 3.6 billion of, we'll call this pre-tax income. And then taxes and net income. Taxes, I'll try to be quieter on the keyboard, sorry about that. Taxes of 659 yields net income of 2963. Let's see, we're off by one, which always disconcerts me. It could be due to rounding. It's often due to rounding, so I'm sure it's fine, but I'm a stickler for detail, and I see that we're off by $1 million. That, for whatever reason, always ticks me off. Well, we'll have to live with it. So, IBM made $3 billion last quarter. $3 billion last quarter. They have 975 million shares outstanding. In fact, we didn't do that. The first thing we typically do is we dive right into the model. The first thing we typically do is look at our basic 6 properties of a company. So why not do that now? What's the stock price of IBM? You can go to Yahoo Finance. I'm just going to go on Bloomberg because I have it open. Stock price of IBM is $137 per share. How many shares do they have outstanding? Well, it's on the first page of the 10Q, but it's also oftentimes in the balance sheet. Here it is, where they have 2.2 billion shares issued and 1.2 billion shares in their treasury that they've bought back. So you have to subtract those two, and you get 970 million shares outstanding, at least as of the end of Q3 15. So the market cap is obviously the product of multiplying the two. There's 970 million shares. So the total value of the company is those 970 million shares times the price per each share, which is 137. And so the value of the company is $133 billion, which is, what is that, about 1/5, right, of Apple. So Apple could buy IBM pretty easily. How about cash and debt? All right, cash looks like they have 9,480 million and then 88 million in securities. So I include that 88 million. They have accounts receivable, financing receivables. That's interesting. Financing receivables. How do we treat those? Interesting. I think that they're not really receivables in many ways. So we're going to ignore those in terms of cash. Long-term financing receivables, etc. They have some investments in sundry assets. I don't like to include that, but it could be another 5 billion in cash right here. So let's just leave it at around 9.5 billion of cash. How about debt? Here's a big slug of debt, $32 billion of debt. So they have a little bit of leverage, as we like to say. They have debt. Here's a short-term debt, $7.5 billion. The total of $40 billion in debt. So they definitely have used debt. So the enterprise value is much bigger than the market cap. The enterprise value is 163 billion, while the market cap is 33 billion, which is, I think, interesting. Any amount of income this company makes, let's say they made 10 billion in any year, it actually would take you 16 years to get your money back. But if you use the market cap, it would be 13 years. But the real answer is 16 years because you have all these lenders you have to pay. On a cash-free basis, right, there's negative $30 billion of cash. There's 10 in debt and 10 in cash and 40 in debt, basically. So it's negative $30 billion in IBM right now. So that 30 billion has to be made whole before a stock owner gets any of it. All right, let's go back to the model. And you should all be able to do this, maybe not as quickly as I can, but sort of in a similar way with just Microsoft Excel or your own spreadsheet software, like I think Google has Google Spreadsheets. So anyway, that was the Q3. Let's do Q2. And we could also do the year before. We didn't do that. We can easily do prior year. So the way we do prior year is we're just going to copy and paste all this stuff, paste it into the prior year, and we just get to pop in the constants. And the formula is like revenue is a formula. Revenue is just the sum of the 3 individual revenues. So you don't have to put that in. You can just put in the hard formula, the hard constants. Sorry, I don't know why I'm so confused. Okay, so we can see that IBM's revenue dropped 14% year over year. New divided by old minus 1 gives us change of 2 figures. So new is M6, 19 billion. Old is I6, 22 billion. And expressed as a percentage, that's negative 14%. So obviously this company is shrinking. IBM has significant issues as opposed to Apple, which grew 2% last quarter, right? So keep that in mind as we try to value these and thinking about discount rates and all those types of things. We have to seriously consider the fact that IBM is shrinking, which is telling us something about their business. Any business that's shrinking, we have to be skeptical, I think, of future cash flows. So let's do the next quarter, Q2. And it gets easier after you set up the model. Each quarter, plugging into each quarter is actually pretty easy. This terrible toothache. It's the first time I can't wait to see my dentist. See what is going on here. All right, so here you can see IBM is just typically making about $3 to $4 billion every quarter. So we'll worry about what that's like shortly, what that means shortly. But as you plug in these numbers, it's a little boring, so you want to kind of notice things as you plug them in, right? You want to notice things like that. And this is why I like to do it manually. It's because you get to learn a bit about the business as you do it manually. You really get to kind of appreciate the numbers on a different level than if you had a computer fill it in or you copied and pasted it or something like that. I don't encourage you to do that. I think it's important that you kind of get to feel the numbers, if that makes any sense. Trust me, it's true. All right, 4250. All right, so we can see here that they have been shrinking 2 quarters in a row now. 2 quarters in a row now. Margins have been pretty steady around 50%. Pretty steady. You might ask why I'm like ignoring a few of these things, like loss from discontinued operations or the difference between basic and dilution shares. You can always ask those later during Q&A. You know, obviously if I'm ignoring them, it's somewhat safe for you to ignore them too. All right, one more quarter here, Q1. You can see this only takes a few minutes if you become kind of used to it. You can very quickly get these numbers in there. And the goal isn't to get the numbers in there, the goal is to interpret the numbers and understand them and make sure that you have a good sense for, you have a great sense for the business as a whole. It's kind of interesting. In Q1, IBM only makes about $2 billion. You can see that, $2.5 billion. So on average, they're making about, you can see the average button here, $3.2 billion per quarter. $3.2 billion per quarter. All right. Now for the 10K, I like to read the press release. I've explained why before. It's an underwriting agreement, so let's see if we can find the 10K quarterly. Where were they when they have issued that? Probably around here. Maybe here. Maybe here. Here it is. Maybe not. Here it is, fourth quarter results for IBM. And this is in their this is their press release. Maybe it makes sense to go to the 10K. 10K. And I want to show you something from the 10K in general. Here's the IBM 10K. This is going to be really important to read. We're going to read it together in a minute. So why not look at it now? They have the sort of two parts of the 10K. A lot of companies have been doing this lately. Not the bylaws, but here it is. Kind of separate parts of the 10K that they separate into links. It's a little annoying. Now you see why I like to go to the press release for the 10K. For the fourth quarter, I should say. Here it is. So because this is the full year 2015, we can infer that the fourth quarter is simply the aggregation, right? 49, 911 minus all of these, if that makes sense. This is 29, 967. This is 1864. And if we subtract, if we add all these up, we get 22,058. And for the full year, it's 81,742, which is just about the same as their 10K, but perhaps a rounding error in there of $1 million, not a big deal. And that's why doing this off the 10K is a little cumbersome, because you have to do all these kind of additions and subtractions. It's not terrible, though. almost done. We're getting a picture of IBM as we do this, right? The picture is they make about $2 or $3 billion a quarter, or about 12 or 13 billion a year. And you can see in 2013 they made 16 billion. They made 16 billion. Why does this all matter? Well, we'll get to that in a second. The price we pay for things is definitely related. Oops, got this wrong. 2581. Maybe not. Yeah, that sounds about right. No, I still got a little off here. Let's see. There it is. Aha, all done. Perfect, okay. I'll do the same thing for Q4. And then we'll be ready to do some analysis. But obviously the price we pay for assets is directly related, obviously, to the amount of cash we get out of those assets. If I told you I'd pay you $1 a year, we determine the value of that to be something like $25, $1 a year forever. If I told you that you could buy that for $10, you'd be very excited because it typically would go for $30 or $25 or thereabouts. The same thing applies to equities. You want to get the most bang for the buck. And we can do that by evaluating the cash we kind of expect to get as a shareholder from a company, like an IBM. And we do that with our NPV calculations. So we're almost done plugging and chugging here, and you can see how a professional investor would start to try to value a company like IBM. I noticed something. We seem to have had a windfall of some kind last year. No matter. Okay, so the picture is in 2014 IBM made 16 billion, in 2015 they made 13 billion, and even in 2013 they made 17 billion. So 17, 16, 13. Their income has been declining, so has their revenue. What does this all mean? Well, we've done this before where we've taken NPVs, and we're going to do that one more time. So now we'll have done it for two companies. There's the 13 billion I mentioned. And so now what will IBM grow in how will they grow in 2016? You can see that they've been declining about 10% a year. So let's assume, for argument's sake, that they'll decline 10% a year even further. So times 0.9 would give us that 10% a year kind of decline. I mean, I assume that it will slow down at some point, right? Like maybe they'll start declining 5% per year. It seems pretty crazy if they were going to decline that much every year, right? How about gross margin? You can see it's been 50% since as far back as we can look, right? So let's assume it'll stay at 50%. Gross profit times 0.5. Even though margins should go down as revenue goes down, right? Typically. Well, let's assume that for now. How about SG&A? Well, let's see how it behaved in 2014. You can see that it dropped. You know, as your revenue drops, you have to cut your costs usually, right? Typically. So IBM's revenue, R&D spending, and SG&A spending dropped as well. Let's see by how much. SG&A year over year, R&D year over year. As we know, we take new divided by old. New divided by old minus 1. You can see their costs dropped. They didn't cut much in R&D. They cut some in SG&A. Let's see how much their revenue fell. It's obviously a dangerous thing. When your revenue is falling faster than your costs, your profit will really start to fall. And you can see that's kind of what happened here. You can see that the revenue dropped 12%. They cut their SG&A by 12%. They didn't cut their R&D by 12%. They only cut it by 3%, which I think is somewhat telling. Okay. And that's why their net income fell by 15%. See, their revenue dropped by 12%, but their net income fell by 15%. Very interesting. And now we're going to forecast their revenue dropping by about 10% and then about 5% a year. So how would their costs decline? I'd say they'd cut their costs in a similar fashion, but maybe not R&D. So let's assume their costs drop by 10% a year, and it just matches the decline in revenue. Let's assume that. Other income will grow because their cash should build up over time. We'll talk about how to treat that in a second. Taxes, well, we can tell what their tax rate is just by doing taxes divided by pre-tax income. Let's see how much taxes IBM pays. Shocker, they pay 21% taxes, or even less. On average, they pay about 19% tax rate. So let's see if Hillary Clinton wins, maybe that tax rate will bump up. But for now, let's assume it's a 20% corporate tax. A lot lower than average person pays, of course. So there's our income stream. So now what do? We forecasted income from 2016 to 2030. What can we do with this? What do you guys think? We have them going from 11 billion to 12 billion to 10 to 9 to 8 to 7 to 6 to 5. Yeah, we could start to get the terminal value and things like that. So maybe they'll drop 5% a year in perpetuity. So we'll take this and we call this the terminal value. We'll do that into perpetuity. Yes, we got to discount it to present value precisely. And let's say the discount rate is what, 5%? So we'll take the NPV from 2016 onward. Enter too few arguments. Bollocks. Let me do it again. There you go. Discount rate. All right. We got 100 billion, 110 billion. How about the cash? We got to include cash. There's negative cash at IBM. So the net NPV is 81 billion, and that means their share price is what? $84 a share, and the current share price is $134 a share. So our model is telling us that the shares should be at 84. But right now they're at 137. So that means that the stock could be a short. It could be 40% more downside. 40% more downside. But we're also assuming that IBM has a really bad time growing. They continue to shrink and shrink and shrink. Well, let's see how much they have been shrinking. Let's see how much they have been shrinking. And then we got to look at the business and see if they'll, why do we think that they'll shrink or not shrink? They have Watson. Isn't that going to help? They only shrank 6% in 2014. So 2015 was a really bad year where they shrank 12%. How about 2012? How about 2012? 2011, let's go back. And then we're going to actually study the business, because that's going to really be what tells us the future. Not just past results don't tell us anything, really. It does give us a scope, though. Let me explain what that means. It gives us a sense. It gives us a sense for what's possible. Come on. Here it is. All right. They discontinued some operations. That's why these numbers don't look the same necessarily. They've been selling businesses, which is another reason why the revenue might be going down. All right, so the revenue has been dropping every year. You can see 2%, 6%, 6%, 12%. So if they drop 10%, it seems like, at least on average, they've been dropping about 6%. So let's assume they drop 6%, maybe forever. They'd really undergo some major shrinkage. We still have a share price of 102 versus 140, so, and our maturity is negative 5%. We're using a discount rate of 5%. All right, so what does this mean? Why is this valuable? I mean, these numbers aren't really good forecasts. They're barely even forecasts. They're guesses. So are these numbers. So the cash flow numbers we're putting into this net present value machine are not really that valuable, or are they? I think they're actually very valuable. So what we can do is we can actually reverse engineer what the stock market thinks. This is my favorite part of finance. If we put in that negative 5% in here, if we put in negative 5% revenue growth and a discount rate of 4.5%, we can get a share price that's almost exactly the same as the current stock market price. So what that tells us is that this is what the stock market thinks will happen to IBM. If the numbers are better than this, the share price will go up. If the numbers are worse than this, the share price will go down. But right now, this is the break even, if you will. This is what people think. This is what the stock market, which is a consortium of minds and actions, this is what the stock market thinks will happen to IBM. It'll drop, it'll hold its gross margins at 50%. It'll hold its tax rate at about 20%. Its revenue will drop 5% per year forever. It has a discount rate of 4.5%, which is a very low discount rate. Let's see what that IBM debt is yielding. Let's see what that IBM debt, 10-year debt. IBM 10-year debt. Oops, pull up the European debt. IBM 10-year debt yields, oops. 1 minute. The IBM 10-year debt yields about 3.5%. So it kind of makes sense for the equity to yield 4.5% in terms of discount rate. That makes sense, right? Equity is less valuable or less riskier than debt. So if we add all this up, this is what the stock market thinks. And it's our job as an investor to see if this is reasonable or unreasonable.
Is this reasonable or unreasonable? Will IBM decline by 5% a year? Will they decline by more than 5% a year? Or will they decline by less than 5% a year? Maybe they'll start growing again. I know their plan, all businesses, their plan is to start growing again. They definitely want to grow again. It's not like they're trying to decline. They really do want to grow again. So before we can really forecast any more accurately, we have to do that thing that we refer to as fundamental analysis. And the first thing I like to do when I look at a new business that I'm not familiar with is I like to do what I call segment analysis, or just segmentation. And what that means is I want to understand each part of their business. And the best way to do that is through their 10K. Their most recent 10K, again, you can get from the SEC website, hit the stock ticker, and the 10K is unlike the 10Q, the 10K really goes in depth. The 10K really goes in depth into the company. So we're going to read this somewhat slowly and somewhat painfully and carefully. The first page of the 10K is very boilerplate. It says the company name, it's got their phone number, and I would encourage you to call the phone number and say, hey, I'm a shareholder. I want to talk to you about the company. And there's nothing wrong with doing that. There's a bunch of people sitting there, and they're paid to talk to you. So there's absolutely nothing wrong with calling that phone number and saying, I want to talk to investor relations. I'm a stockholder. Even if you own 100 shares, it doesn't make a difference. The nice thing about the first page of the 10K is it also tells you how many shares outstanding there are. It typically does, at least. It does tell you the market cap, which is 159 billion. All right, IBM was incorporated in 1911. It's sometimes nice to know the history of these companies. I like to write that down sometimes. Incorporated in 1911. It was called the Computing Tabulating Recording Company, CTR. Funny. The company creates value for clients through integrated solutions and products that leverage data, IT, and deep expertise in industries and business processes and a broad ecosystem of partners and alliances. Okay. IBM solutions typically create value by enabling new capabilities. A lot of corporate speak here, not very direct. These solutions draw from an industry-leading portfolio of consulting and IT implementation services. This is maybe the only real sentence in this whole paragraph. Industry-leading portfolio, we can remove that. That's corporate speak. And these solutions means IBM's business is consulting and IT implementation, cloud and cognitive offerings, and enterprise system and software. That's it. This whole paragraph, this is the translation. IBM's business is consulting and IT implementation, cloud and cognitive computing, and enterprise systems and software. Okay. That is a little more understandable than this kind of corporate speak. In 2014, the company's strategic imperatives were declared around the three main forces of behind quote-unquote digital: big data and analytics, cloud, and engagement. Not sure I understand what that means exactly. Since 2010, IBM has invested $30 billion, built out the IBM Cloud on a global scale, established the Watson Group, announced 50 acquisitions, including the landmark alliance with Apple to bring mobile to the enterprise. Okay. As IBM's clients transform, digital itself is not the destination, but a foundation to create a truly cognitive enterprise. So we use the phrase enterprise often in business to mean businesses, as opposed to the consumer. The enterprise is other companies. So IBM is mostly an enterprise software and services company. They don't sell to consumers. There's no IBM computer you can buy. You'll never interface with IBM as a consumer. So keep that in mind. They sell to big businesses like JP Morgan and Walmart. IBM is emerging as more than a hardware, software, and services company. That's kind of BS. transforming into a cognitive solutions and cloud company. Cognitive, advanced analytics and key data, cloud platform, industry focus, IBM's Watson can see and analyze the massive amounts of data that have previously been invisible to computers and enterprises. It's all kind of bullshit to me. Cognitive systems are not programmed. Like humans, they learn from experts, from interactions, and from big data. Ultimately, they can augment human intelligence, allowing individuals to make more informed decisions. Bluemix. Building cognitive apps through Watson Developer Zone on Bluemix. I'm going to write that down. So model is a good place to take notes. You can write down all your notes in a model. And some of my models are hundreds of pages of notes on businesses that I've followed for decades. Never really followed IBM, so now's a good time to start. Nearly half of IBM's research spending is focused on analytics and cognitive. Okay. IBM's leading-edge cognitive technology is only the starting point. The company is developing entirely new solutions businesses around cognitive. The Watson Health Unit was formed, the first business unit designed around an industry. Watson Health will integrate cognitive solutions that help doctors diagnose and anticipate disease. Well, I know something about that. The Internet of Things. 9 billion internet-connected devices. They have a cloud platform. All right, here's the business segments. Business segments and capabilities. The company's major operations consist of 5 business segments: global technology services and global business services. Global technology services, they'll probably abbreviate that as GTS. Global businesses. Global business services. So vague. I hate this corporate speak. Which the company collectively calls global services. Alright, so this is just global services. Wonder what the difference is. Alright, so they have the services business, the software business, systems hardware, so probably like mainframes and stuff like servers, and global financing. So let's see, 1, 2, 3, 4, 5. I'm guessing Watson is a part of software, but who knows? Global services, critical component of the company's strategy of providing IT infrastructure. The solutions include IBM software and systems as well as other suppliers' products. 60% of services segment is an annuity-based, coming primarily from outsourcing and maintenance. GTS provides IT infrastructure services. Okay, so it's outsourcing in essence. How about GBS? Software is easy, but it's middleware and operating systems. IBM has a bunch of software, good software actually. WebSphere is one of their major pieces of software. Watson is another. Let's move Watson under software. How about hardware? They have servers and storage. financing is pretty obvious, right? It just helps their customers buy their goods. So let's see what percentage each of these make up. That'd be interesting, right? That's what I mean when I say I want to look at the segment analysis. Currency may have hit IBM more than we've been thinking. We got to look at that in a minute. We still maintain that the markets expect about a 5% annual decline in IBM. We can use their NPV calculator to impute that. All right, so here you can see global technology services is 32 billion and global business services is 17 billion out of 82 billion. So we can actually do a percent of revenue marker here where we can say the percentage of revenue of all global services is 32 plus 17 divided by 81.7, which is 60%. So IBM is 60% services. How about software? 22.9 billion over 81.7. So it's 28% software. And together, that's already 90%. How about systems? Systems, 7.5 billion. So they're really not selling much. Servers and storage. Together, that's 97%. The last 3% is obviously financing and other. Let's just do 1840. Yeah, so that equals 99%. So you can see that the business is dominated by services and software. Everything else is, and most of it's services. So let's see the difference between global technology services and global business services. 32 divided by 81.7. So 40% is GTS and GBS, whatever that is 21%. That makes 60. Cool. So that tells us a little bit about their business. I like to save this in my model, so I accrued this information over time, and you'll see me make all these notes like this. I'll do GTS. I'll type name, global technology services, and one of the things I might want to write down is clients. Like, who are their clients? Is it Walmart, Microsoft, JP Morgan? Who are their clients for global technology services? It's probably huge businesses. And huge businesses like JP Morgan or Goldman Sachs or even Facebook, they're going to need IBM's consulting to understand their IT infrastructure. Should we use Amazon Web Services for some of it? Should we use Akamai? Should we use what kind of software? How do we set it up? And of course, IBM will sometimes say, well, I think you should use IBM software. But sometimes, hopefully, they'll say that they should use some other company's software. And that's kind of the way their business probably works. I know a little bit about software. I used to follow it a little bit, not too much. Okay, so that's sort of a quick read of the 10Q. We have to read way more. One of the things that I like to do is I like to go to their website. And it's interesting, they keep talking about Watson, cognitive computing, and all this stuff, but at the end of the day, most of their business is just consulting. It's just consulting. 60% of their business is just plain old consulting. And I know a little bit about their software business, and a lot of their software revenue is also kind of old database software and middleware software, which is also not that exciting. So they're really trying to make themselves sound sexy and cool, but they really have a bunch of old kind of software. So you can see why people think the markets assume that they'll shrink by 5% a year. Let's see what happens. This will be fun. Let's see what happens. What are these shares worth if they don't shrink 5% every year? What do you think they'll be worth if right now the shares trade for $138, and our calculator, our model, which I'll upload to the share drive after, our model tells us that if that's the case, they'll have to shrink 5% a year to be worth $137. So maybe, let's see what happens if they have 0% growth. In other words, they keep their business flat. So they don't shrink from 82 billion to 37 billion from 2016 to 2030, and we'll keep the terminal value shrinking at 5%. Let's see what happens if for 15 years they can hold their ground. I wonder what happens. I have to change this to 1. I wonder what the shares would be worth. Wow, the shares would be worth $335 per share. Almost triple. Almost triple if they could just hold their revenue every year. Pretty amazing. But if they held their revenue every year, their costs probably wouldn't drop every year. So we probably have to fix that. That's an error. Let's assume they have the same costs every year as well. All right, that's a little more reasonable. It's a little more reasonable. It's not a double or a triple. It's a 30% gain. Because we have their costs dropping with their revenue. So if their costs stayed the same, that makes sense. Well, what would happen if they grew? Let's say they grew 5% a year. Let's say they grew 5% a year from here to 2030. And I assume their costs would also grow 5% a year. That would make sense. Okay, then their shares would be worth $300 a share. So you can see just a little change in the growth rate every year can really make a big difference. But of course, the market thinks they're going to drop by 5% a year. And we have to, the way that we're going to try to figure this out is we're going to have to look at similar companies. And similar companies to IBM are not Apple. Their competition for consulting services are companies like Accenture. In fact, Accenture is I think they're a public company. They may not be anymore. They were a public company at some point. Yeah, I guess they're private. Oh, let's see. No, they're still public. Accenture. It's a consulting company. There's another company called Infosys. Similar companies to what IBM offers. Software, they have competitors like Oracle and SAP. Watson, I don't think they have any competitors. Maybe Google. Hardware, they have competitors like EMC and Dell. I guess Dell now, just Dell. Financing is such a small part of their business. It's not really a part of their business. Xerox, sure. Lots of different competitors. So IBM is more of a consulting company that's got a little bit of a weird kind of software business more than it is anything else. They've kind of sold the rest of their stuff. So we're going to have to model Accenture and Infosys. What other similar companies? Let's see here. Cognizant, Tata, these are all consulting companies. I know Tata has been a great company. Tata, Cognizant. These are their competitors. And these companies go into these major companies, and they try to give them advice on how to deploy a really big tech infrastructure, which is not as easy as it sounds. And these companies like JP Morgan or an Amazon.com, they spend millions, tens of millions, maybe even hundreds of millions on their infrastructure. So it's interesting. You might have thought IBM was a computer company. It's really a consulting company. And we're going to learn more and more about what does a consulting company kind of look like. But if we think about NPV, again, we kind of get a shortcut for earnings ratios. So let's look at a price to earnings ratio, or enterprise value to earnings ratio. We know the enterprise value of IBM is 16 billion, right? So the enterprise value right now is 160 billion, excuse me. And the 2016 earnings are projected to be, according to our model, 13 billion, 13.3 billion. Let's see what Wall Street thinks. Let's go to Bloomberg and see. And I know that Yahoo Finance has this information as well. Let's see what yeah, so Wall Street thinks it'll be 12.7, which is pretty close to 13.3. Pretty close. So the enterprise value to earnings ratio is about 12.2 times. What does that mean? Well, it means that it will take 12 years, right? 12 years of $13 billion to get back $163 billion. You're paying $163 billion for this company, even if you buy one share. You're paying as if the company is worth $163 billion, because you have $133 billion for the shares and another $30 billion for the net cash, right? So the company is going to make $13 billion this year. So at that rate, it'll take you 12 years to make your money back. Well, that's kind of interesting. So if you think about it as a yield, IBM is yielding 8%. And that's a lot higher than their bonds, which yield 3%, roughly, right? 3%. Or any other bonds. Most bonds aren't yielding 8%. So that's pretty exciting. That's pretty exciting. But the company's been shrinking, and if they continue to shrink, they won't make $13 billion a year. They'll make less than $13 billion a year. Next year they'll make 12. The next year after that, you can see they'll make 10 and then 9. And that you won't count on that 18%. The concept will constantly be changing. So I hope this gave you an insight into sort of how to play with numbers and understand things. The next hour I'll be working on kind of how to get more detailed and in-depth on these companies. I like that. Consulting companies are people with computer checklists. In many ways that's true, but at the same time, it's sort of interesting. Like if you have, there's only a few big consulting companies, right? IBM, Tata, Cognizant, Accenture. And if you're JP Morgan, right, and you're going to deploy a global technology infrastructure, you don't want to do that by yourself. You want to have advisors. The same way that you don't file your own taxes or you don't do your own legal work, you want to have consultants who are there to assist you, especially because those consultants are helping other companies. So if you're JP Morgan, you go to your IBM people and you say, hey, what is Goldman Sachs using for web filtering? And they say, well, they're using WebSense. You should use it too. And JP Morgan guy says, yeah, that's a good idea. So you have an ability to kind of gain information that's there using these consultants. So it's sort of like any other consulting industry, like law or accounting, auditing, stuff like that. So anyway, I went to IBM's investor relations website. Here's their investor relations website. And we can dig into these financials. So there's the press release for every quarter. There's the audio.
Welcome and thank you for standing by.
Maybe open
At
this
this
up.
time, all participants are in listen-only mode. Today's conference is
It's MP3 file. You should
Welcome
listen.
and thank you for standing by.
You should be listening to these MP3s instead of Kendrick Lamar. I'm telling you.
At this time, all participants are in listen-only mode. Today's conference is being
Let's read
recorded.
the press release.
If you have any objections, you may disconnect.
Look how
at
old
any
school
time.
this is. I
Now I
love
will
it.
turn the meeting over to our
I love
host,
it.
Ms.
No
Patricia
graphics.
Murphy,
Just old
Vice
school
President of
typewritten.
Investor Relations. Ma'am, you may begin.
Thank you. This is Patricia Murphy, Vice President of Investor Relations for IBM.
Remember what I said
I'm
yesterday?
here
You
today
should
with
call
Martin
her.
Schroeder, IBM Senior Vice President and Chief Financial Officer. I'd like to welcome you to our fourth quarter earnings presentation. Prepared remarks will be available within a couple of hours, and a replay of the webcast will be posted by this time tomorrow. I'll remind you that certain comments made in this presentation.
So they're going to read the safe harbor statement, but before we do that, the first thing, like I said, the best thing you can do is read a year, at least a year, of all the press releases of the company. That's even before, don't even think about investing or trading. You have to read at least a year of the press releases. And as you're reading them, you want to put that information from on. The first thing I saw, I kind of ignore the net income stuff. I want to start with revenue. I'll go back to this later. The first thing I see in revenue from continuing operations, $22 billion. Okay, fine, I know that. It's in my model. So I don't have to go to my model. down 2% after adjusting for currency. Whoa! Down 9% as reported. What? Well, first they're telling me it's down 9%. I'm looking at this and I see down 9%. That's pretty stinky. 9% decline smells bad. That smells like me. I never take showers. But then they say that's the reported amount. The actual amount is 2% when you adjust for currency swings. So we call that revenue reported versus revenue local currency. So they only dropped by 2%. They only dropped by 2%. I'll make sure you guys are reading what I'm reading. They only dropped by 2%. And that means our forecast for the future is maybe too aggressive. We think they're going to drop by 5% a year, but maybe they're only going to drop by 2% a year. Let's see what happens if we pump that in. 0.98. 0.98. And they cut their costs by 2% as well. Now the shares are actually kind of cheap. Not by much, they're basically fairly valued. But it's telling, it's very telling. And then the other big error in this model is this line, which we'll get to in a minute. In fact, I'm going to color it yellow because it's really important. It's the interest income. And we're going to have to think about that really carefully. All right, where were we? So yeah, so it looks like their currencies, and I wonder why their currencies were like that. Let's make a map of the US dollar to euro currency exchanges. Let's look that up on a quarterly basis if we can. So let's see, first quarter of 2014. Oops. The average euro price was $1.37. Let's go to the next quarter. Q2 14, it was also $1.37. Make sure I got that right. Yeah, 137.04, 137.16. How about the third quarter? 7.1 to what? 8.9, 9.30. Then it was 132, dropped quite a bit. 132.52. Okay, how about the fourth quarter? 10, 1, 14, 12, 31, 14. 124.88. IBM is an international company. Literally the first letter of IBM stands for international. So we have to look at the currencies because this could be a big impact. 112.68. Big drops in the euro relative to the dollar. 110.69, another drop. 111, kind of stabilizing. And how about last quarter, literally just a few months ago? 109.52. So if you do a year over year, you'll see that the euros dropped 12% year over year. So you can't blame IBM for dropping some of it, because at the end of the day, they would have dropped 2% if they only would have dropped 2% if the euro is a little more stable. So IBM is maybe not shrinking as fast as we thought. Where's the euro right now? Soon the euro is sort of staying stable. So if it stays at this rate, you can see that the currency is not going to drag anymore. Last quarter, it dragged 12%. But next quarter, the euro will actually be flat year over year. And the quarter after that, and etc. Because the euro can't go down forever. In fact, it'll probably rebound at some point, and then IBM will report revenue growth that's it's actually more than you would expect. So chances are IBM isn't shrinking nearly as much as it looks like. That's very interesting. Let's keep reading and listening. You learn a lot from this.
Presentation may be characterized as forward-looking. under the Private Securities Litigation Reform Act of
So
1995.
immediately I see, I want to keep
Those
track of
statements
this.
involve a number of
Services
factors that
backlog.
could cause
What is
actual
that?
results
What's a
to differ
backlog?
materially. Additional information concerning these factors is
Wonder.
contained in the
What's
company's
backlog?
filings with the
Sounds
SEC.
important.
Copies are available from the SEC, from the IBM website, or
121
from
billion, that's a lot.
Investor Relations.
I wonder what that
Our
is.
presentation also includes certain
Apparently it was
non-GAAP
up
financial
1%.
measures in an effort to provide additional information to investors. All non-GAAP measures have been reconciled to the related GAAP measures
See, I'm putting
accordance
in
with SEC
This
rules.
data as I'm
You'll
reading.
find reconciliation charts at
Full
the end of
year.
the presentation and in the Form 8.
Full year is only down
to the
1%,
SEC.
adjusting for currency.
Now, I'll turn the call over to Martin Schroeder.
That's even better.
Thanks, Patricia. Let me start by saying we're pleased with the progress we made again this quarter. We delivered revenue of $22.1 billion, operating net income of $4.7 billion, and operating earnings per share of $4.84. As we get into our results, you'll see that our fourth quarter and full year performance reflects the transitions in our business as we address the significant shifts in our industry.
I don't like it that the CEO of IBM can't be bothered to join the conference call. I don't play that. Tim Cook goes on the Apple conference call. Why is she so special? IBM's 5 times smaller than Apple. All right, so you see here, this is another thing I want to point out as you read through this. It says revenue from continuing operations is $82 billion, down 1% adjusting for currency. So here it says down 12%. But now they're trying to tell us it's down 1%. Well, I don't believe you. Explain to me why it's not down 12%, it's down only 1%. Well, 8 points came from currency due to the weak euro, I'm guessing, and 3 points from divestitures. What's a divestiture? It's when you sell a business. So obviously, if you sell a business in 2015 or in 2014, you're not going to get the revenue that you were getting from that business anymore. You're going to get cash instead. And if you decide to sell one of your businesses, like I know they sold their PC business to Lenovo, the laptop business, you're not going to be able to book your revenue anymore. But you have to exclude that out if you want to think about what's going to happen in the future, right? So if they're only going to shrink by 1% in the future, 1% in the future, then we're really looking at even better, $163 stock instead of $137. And this maturity of negative 5% seems really onerous, right? That's when we thought this was a really fast shrinking business. Maybe it should just be negative 3%. Oh my gosh, now it's $180 a share instead of $140. That's almost starting to get to the level where it's worth buying. What if it was negative 1%? What if they just shrank 1% every year from here on out, just like they did last year? Then you're talking about a $200 stock versus a $137 stock today. Well, what about cash? What about cash? I actually want to point this out. This is really important. Let me show you something that's really crucial. Will help you understand how finance works. I'm going to pause reading the press release. I'm going to pause the conference call, and this is so important. I'm going to point it out to you. We're going to go to the most recent statement, which is the 10K. We're going to go to the financial section where the balance sheet is. Where's the balance sheet? Financial position, page 78. Let's go there. We're going to jot down the balance sheet really quick. So cash, 7686, 508, accounts receivable, 8333, financing receivable, 1920, other account. How many accounts receivable do you have? Jesus. Property, plant, and equipment. Long-term financing receivables. Jesus. Pension, deferred taxes. We know I like to add goodwill and intangibles in one line, since it's all gobbledygook. Sum should equal 110,495. It does. $4,822 pre-pension. 1734 is no, that's deferred taxes. This is pension. This is PP&E. No, this is long-term financing receivable. PP&E, prepaids, inventories, other receivable, short-time financing receivable, accounts receivable. Do they have inventories? Where are the inventories? 1551. I already did that. Okay. So that's the balance sheet on the asset side. How about liabilities? taxes, debt. Add short-term debt and long-term debt. So there's one debt. Accounts payable, of course, compensation. Deferred income is deferred revenue. Other accrued. Retirement, that's pension. You can argue that that's actually debt. Shareholders' equity. Sum it up. It should be 10,495. It's 10,496. That's close enough. Taxes, debt. All right, so here's the debt. Here's the cash. So net cash is negative 31 billion. And of course, the main page, we use the Q3 cash. So let's do 8194 and 39889. All right, so here's what I wanted to show you. Let me just fill this out for posterity's sake, just to finish up here. Compensation for revenue. Other. It's weird. Hang on. This is deferred revenue. Debt. Taxes, debt. Accounts payable. Here we go. Compensation. Other. Retirement. Deferred. Oh, it's long-term deferred revenue. I should collapse those into one. 3771. All right. 8099 is other. So shareholders' equity, liabilities plus shareholders' equity. Okay, so here's what I want to show you that's kind of important, and it's arguably the secret of finance. They had negative $31 billion in cash at the end of 2015. So what is the number, what is their cash at the end of 2016? How do we forecast that? Whoever is the smartest person in this chat will figure that out. While I get a new water. Who is the genius? Maybe I'll even eat this fruit by the foot. They have negative $32 billion in cash at 2015. How much will they have at the end of 2016? Who is the genius? Do we have a genius here? No. Not the rate of change of the dollar. Come on. What is that? Burn rate? IBM makes money. There's no burn rate. I'm so disappointed with you guys. So disappointed with you guys. Let's see some more people who have some answers. There you go, Coke Zero. That's our reliable Coke Zero who's smarter than everybody else. Well, think about it from your own perspective. Let's say you make $50,000 a year, and in our imaginary world, you don't have any costs. Or maybe you make $100,000 a year, and you spend $50 on yourself. So at the end of the year, you make $50,000. And if you started the year with $50,000 in your bank account, you ended 2015 and you began 2016 with $50,000 in your bank account, and you made $50,000 in 2016, well, you'd have $100,000 at the end of the year. IBM's the same thing. They started the year with $32 billion in debt, and they're scheduled to make net income of $13 billion. So we're just going to add these two up. All right, maybe someone can tell me how much they're going to have at the end of 2017. That's right, about -7. And so forth and so forth. That's right, net cash plus net income. Yes, dividends and buybacks will subtract from cash, but we don't know what dividends and buybacks will be. So let's just forecast it this way. And trust me, this ends up working really well. So I'm going to copy and paste this number all the way out to 2030. And look at that. By 2030, IBM will basically have made back, and if they don't pay a dividend or do a buyback, they'll have made back all of their cash of their current market cap by 2030. Isn't that interesting? You can increase the resolution if you can't see the numbers in the screens. It should be very high resolution. Now, if the company is $100 billion on their balance sheet in 2016, how much should they be earning in interest income? What do you guys think? We're assuming that net income approximates cash flow. And we'll do cash flow lessons later. Don't worry, I'm not going to miss cash flow. And this is the key to finance. Companies should be using their cash Companies use their cash to make strategic investments, buybacks, for instance. A buyback is a strategic investment in your own stock. An IBM stock is yielding 8%. 8%. Right now, we're assuming their interest income. Let's see. Let's see kind of what yield are we assuming. Not a very good one. 1%. They're buying back their stock and they're thinking they're making 8%. You can make 1% in your sleep, right? They're even making money when they have debt. So one thing we can add to this is actually called ROIC. That's return on invested capital. We can assume that IBM will make 1% or maybe 1.5% every year on its cash balance. That's a crazy idea. So we'll start it here. We'll assume that they make 1.5% every year. It seems like they make, if you look at their thing here, they make 1.5 billion, and then they have financing costs. So let's actually put that instead. Plus 1,500 times whatever this number is, multiplied by negative 1.5% in this case, or 1.5% when it's positive. Hold up. We them boys. All right, there we go. So if we do that, we can see that we're going to give IBM credit for holding and making money. Now, they could give this to us in the form of dividends, and then we'll just take that money and invest it. So this is a very appropriate way to treat it. And if we can see it like this, you can see that the current shares of IBM, if they shrink a little bit every year, are worth almost double where they're trading at. Maybe that's why Buffett's so attracted to this. Maybe that's why Buffett is so attracted to the stock. It does kind of look cheap. The fact that they're a consulting business that is not growing very much kind of makes sense. Tech is sort of deflationary, so I wonder if, but I'm not sure tech is deflationary for big businesses. Big businesses need to spend maybe more money on tech. It's hard to say. But it certainly looks attractive. Now, making double your money in a stock is very attractive, especially a company like IBM where there's a lot of safety. Now, we're still making some assumptions here that we're taking a lot of liberty on. We got to be very careful about those assumptions. So, but that's the idea that companies take their cash and invest it is something that's so important to the way I value companies. And estimating what kind of return will they get. If it's 0.5%, some companies can make a huge amount. They can make 4, 5, 10% sometimes on their cash. Over the long run, it's very hard to make that much money. But there are companies like Gilead that's sort of the intangible. So now we have sort of 2 or 3 intangible aspects that we have to guesstimate that all push and pull on this NPV. How much money can the management team take, and how much money can they make for the shareholders by investing their cash in projects like Watson? What will the company look like, and what will their maturity rate be in 20 years? Will they decline in perpetuity, and by how much? And how much should we discount those cash flows? Those are the 3 kind of main conceptual ideas when we model a company. In this case, when we give it our best guess, and we kind of see that the shares are pretty cheap. They're pretty cheap. Forgot how we felt about Apple. Let's open up our Apple model and we'll see. Apple. How did we feel about Apple? We tended to think that the stock could be a short. But we also assumed that the company would fall apart. So maybe let's be less nasty to them. Yeah, Apple certainly doesn't seem as good of an investment as IBM. Now, we're also using a high discount rate, so we're using 4.5% for IBM, so maybe we'll use 5%. 5% for Apple, maybe we'll make it negative 2% maturity. This will be a little nicer to Apple, but we still only get a stock price that's similar to the current stock price, whereas for IBM, we get a stock price that's a lot higher. Now for Apple, we didn't do this ROIC concept. So we should do that at some point too. But we'll be building all of these models at the same time. Let's go back to IBM. Let's keep listening.
As well as some of the cyclical challenges of the global business environment. So as always in January, I'll start out with some comments on the year, show you the progress we've made in our transformation, discuss the details of the quarter, and then wrap up with our view of 2016. For the full year, we delivered nearly $82 billion of revenue and $14.7 billion of operating net income, and our operating earnings per share were $14.92.
I'd like to address something really quick. One comment in here that I thought was interesting. One guy writes, "There's no way it's going down with the release of iPhone 7 in a few months." Well, that's not a reasonable perspective. Let me spend a minute and give you all a little lecture on news. There was a school of investing a long time ago that is basically out of favor right now. And it, in essence, was called, and this comment was a very dull version of that school of investing, and it was called, one moment while I get my stylus. It's called information arbitrage. And basically the idea was that if you could get information about the company's forthcoming news, and you can try to trade on it and estimate what would happen to the shares based on how favorable that news, or unfavorable in some cases, the news might be, you were able to basically outsmart the market and make a high rate of return. Well, not many people practice information arbitrage anywhere. One, considering most of it is illegal, trying to get insider information is certainly illegal and not a good idea. But there's also this dynamic that occurs where there's no arbitrage concept kind of comes into play. And let me explain what that means in a second. Basically, the upshot is that news and stock prices, in my opinion, this is not a commonly held view, but I've been around the block a little bit, and it's my opinion. You don't have to listen to it if you don't like it, but I think it's true. And I'm going to try to prove it a little bit here. News and stock prices don't really have anything to do with each other, especially if something is quote-unquote good news or bad news. And I'll explain that and what I mean by it in a minute. But I still need my stylus to do that. There's so much junk around here that I can't find it, but I think I know where it is, actually. Give me one second. Aha! Aha! I found it. Okay. So the concept here is that let's say you know that this is the Apple stock price. It's unpredictable, let's say. You don't know. In fact, that's too predictable. Let me try it again. It's very unpredictable. Okay, and you know that, let's say this is 2016 so far, and you know that the iPhone is being released right here. Well, there's no arbitrage that you can take, because everybody knows this. Everybody knows. Everybody knows that the phone will be released on that day. So it's not possible that you can load up into the stock, buy the stock, and hope that it goes up and then sell it right after the news, because everybody knows that news will be that day. So there's no way to game it if everybody knows that's when the news is going to be. The only way that you could really do something like that is if you knew in advance that, let's say, there was a great new feature, like the iPhone, that nobody knew about. There was a surprise, in other words. There was a positive surprise in versus expectations. If you knew that the iPhone had some amazing feature, like they were gonna, I don't know, they finally figured out how to make Siri much better. Siri is much better. And you knew in advance, because Tim Cook called you and he told you, Siri is going to be perfect. It's so smart, you're going to be amazed. We really worked on it, and it's top secret. Well, then you knew that there was going to be a surprise versus the expectations. And then you could buy it and make a lot of money. But then you would go to jail, because trading on insider information is illegal. It's illegal, and many people have gone to jail for it. I've never been accused of it myself, but it is very illegal. I've never done it myself. It's very illegal, and it's not something you want to do. And it's probably not something you can do either. But if you could do it, perhaps you'd be tempted to do it, but you would rapidly go to prison. So there's no real way. Perhaps you knew that, in fact, expectations were low. Expectations for the iPhone, I guess the iPhone 7, right? You knew that the iPhone 7 was going to be a very blah, it's a technical term, a very blah or blasé, maybe is a better term, a blasé release without many new features. It's going to be another iPhone. And then maybe you had a hunch that maybe it's not going to be that boring. Maybe it's going to be exciting. Maybe they're going to do something once and for all to actually make it a better phone. Or maybe there was a lot of hype. Maybe the expectations were that it was a lot of hype. And you said, you know what? I don't think they're going to live up to the hype. I think that this is just going to be another boring iPhone. Then the shares would fall. They'd fall on that news, wouldn't they? If it was really an underwhelming iPhone launch. Because the problem is iPhone's slowing down. It's Apple's biggest product. So you could have this news release scheduled months from now, and they could actually fall on the shares if they don't do something exciting. So the pressure is on. You know how excited people were and hyped for Steve Jobs' iPhone releases. What are they going to do that's going to be so exciting? Is iPhone going to drive you around? What can it do that it doesn't do already? Can you watch movies on it? I don't know. I'm not a tech expert, but what could they put in there that's exciting? Can they release a brand new, different product like the iCar? That will pop the stock, potentially. But trading on news is not really investing. It's kind of guessing. and its psychology. And I like to do my investing more quantitatively as a value investor. This whole gibberish of watching the stock price and trying to understand it is not, I think, real investing. It's very difficult and very hard to do. So we have about half an hour left, and we can sort of take this in any direction. We can do Q&A, or we can keep going. What do you guys think we should do? The currency adjustments are really important. I'm going to put that in here. Okay, I think most people want me to keep going, so we're going to try to do that. So let's go back to this 10K, and maybe let's listen a little bit more to the IBM earnings call. This is the CFO speaking.
As we've said, this transformation will play out over time, and with revenue down 1%. For the second consecutive year, we've had modest improvement in our year-to-year revenue performance, excluding the impact of currency and divestitures. I'll comment on year-to-year revenue performance on this basis throughout. Our strategic imperatives continued strong performance, up 26% for the year. This now represents 35% of IBM's revenue. Our profit and margin reflect our portfolio actions.
I think it's funny that they have this strategic imperatives is doing 29 billion, and that's growing a lot. So that means strategic imperatives. And this is the good, in essence, I always find it's hilarious when companies do this. They say, this is the good business, basically. This is the good business. It's up 26%, or up 17% as reported. So this is the good business. It went up from 24 billion to 29 billion. So that means the rest of business, ROB, rest of business, really went down by a lot, right? I always find it funny. They say, well, if you look at just this part of our business, it's going really well. It's kicking butt. It's up a lot. Well, that means the rest of your business is falling apart because the business in total is down 1%. So it means your consulting business is getting killed. Why? Are other consulting companies getting killed? I wonder. Is Accenture? Let's look at Accenture and Tata. How about Tata? Tata's an Indian company. They must be losing market share to Tata. Let's see, sales. Tata is shrinking too. Tata is down 6%, down 11%. How about Cognizant? Cognizant is a big competitor of theirs. Cognizant's growing. Cognizant's doing fine. Cognizant's kicking butt. How about Accenture? Accenture's not really growing much, but they're growing a little bit. So why is IBM dropping 22%? The rest of their business. Their strategic business is going up a lot, sure. But that means that their non-strategic business, which is, by the way, twice as big as their quote-unquote strategic business, is dropping even faster. So I just kind of think that's kind of bullshit when I hear stuff like that. Cloud revenue is up 50%. Wow. That's good to hear, but again, why is the rest of the business dropping so fast? All these small businesses are doing well, but their major business is dropping. And you can see here that free cash flow is about equal to net income, which over time it usually is. All right, let's keep listening. Yeah, Yahoo Finance mimics the Bloomberg, and it's free, so.
As we shift to higher value, as well as the level of investments we're making to drive our transformation. We generated over $13 billion of free cash flow, which is up year to year. This is 98% of our GAAP net income, in line with our expectations that free cash flow realization will be in the 90s. A couple of years ago, we laid out our strategic imperatives around big data and analytics, around cloud, and around mobile and security, the areas where our clients are looking to us to help move them to the future. I want to spend a minute on the progress we've made since then in shifting our business toward these strategic imperatives and in the investments we've been making, which aren't yet reflected in our revenue streams.
It's interesting. As a consulting company, IBM has a little bit of conflict of interest, right? They help big companies prioritize their IT, but they're also the only company of those companies, Accenture, Tata, and Cognizant, that actually has products, right? So they have a conflict of interest. They want to pitch you IBM products, but meanwhile, Tata and Accenture, they don't have software or servers. They're just saying, hey, I think if you want a great IT system, you need Dell servers, Oracle software, our programming, I guess, and consulting, and I'm going to pick you the best parts of the IT system, Cisco routers, whatever. Whereas IBM saying, well, I think you need the IBM software, not the SAP software or the Oracle software. You want the IBM software. And then if you're the JP Morgan technology people, you're like, I don't know if I can trust you. It sounds like you have a conflict. Anyway, that's one thought.
Said we expect these strategic imperatives to deliver double-digit revenue growth, and in 2015, our performance in our strategic imperatives accelerated. Together, cloud, analytics, mobile, social, and security grew 26% and delivered $29 billion in revenue. As I mentioned, they now represent 35% of IBM, which is up from 22% 2 years ago. With 57% revenue growth over the last year, cloud is now a $10 billion business for us. This made us the largest cloud provider in 2015, which is what you'd expect given our extensive relationships in enterprise IT and incumbency in the data center, positioning us to help our clients implement hybrid cloud environments. Revenue from our as-a-service offerings increased about 60% to $4.5 billion for the year, and we exited 2015 with an annual run rate for our as-a-service business of $5.3 billion. The $10 billion also includes $5.6 billion of revenue from our foundational offerings, where we provide software, hardware, and services so clients can build their own clouds. In either case, what we've been saying for some time is that clients are utilizing the cloud not just to reduce costs, but to gain agility and enable innovation. And whether they're consuming as a service or through their own clouds, or as in the case of most enterprise clients who are implementing a hybrid environment, we're leading that move. To address opportunities we see in this space, in 2015 we made 7 cloud acquisitions, including CleverSafe for object storage, Graviton for cloud brokerage services, and Clearly for cloud video services. We also invested nearly $1 billion in capital, expanding our global cloud data center footprint to 46. We already have an ecosystem of millions of developers globally, and our Bluemix platform as a service has already expanded to over 1 million users, adding 15,000 developers a week. With nearly $18 billion of analytics revenue, we're also the largest analytics provider, and will extend that lead by moving into new areas, including Watson Health and Watson Internet of Things. In Watson Health, we're integrating our own organic capabilities with content acquired through Merge, Phitel, and Explorus. Healthcare is a new revenue and profit opportunity for us as we change the face of healthcare through our cognitive platform to provide value to providers, payers, and partners. We're also addressing the IoT market. Our Weather Company acquisition not only gives us tremendously valuable data and digital content, but a high-volume, cloud-based, insight-driven platform that will integrate with Watson to address significant new opportunity spaces. We'll talk about how we're addressing these opportunities at our investor briefing at the end of February. And while we're investing in capabilities for the future, we're also returning significant value to shareholders. We paid out nearly $5 billion in dividends, and we reduced our average share count by 2.7%. So we got a lot done in 2015.
It's about 50%
Our
US
revenue for the year was
business.
down 1%.
That's why the currency is affected so much. There's so much Europe and Asia business. See, the margins on the consulting, about 30 to 40%. The margins on the software are really high. But, they're not declining too much. It's the currency that really obscures it. In fact, the software is declining the most, down 6%. That's currency adjusted, I'm guessing. It's down 2 instead of down 9. It's interesting. Here's the services. They're saying, here's the breakdown of services. This is interesting. I haven't seen this before. Maintenance, ITS, Integrated Technology Services, outsourcing, and CS&I, Consulting and Systems Integration. So outsourcing, that's interesting. So it's half of consulting is outsourcing. About half, 44%, is outsourcing. I always like to know what these companies do. You know, I insist on it because otherwise you get really kind of perplexed as to what their business actually is. You'd be surprised at how many investors don't really care. Outsourcing. Basically, it's, you know, taking a process that's within one business and moving it to another, right? That's what outsourcing is. Interesting. So the biggest business is consulting, global services, and the biggest percentage of global services is outsourcing. So it's a lot like Accenture, Infosys, Tata, Cognizant, who again are all growing. So it sounds like they're Cognizant and Accenture may be taking their market share. Now, having said that, Cognizant and Accenture don't only do tech. Cognizant does, Accenture doesn't. Infosys does, though. Infosys and Cognizant seem to be growing really fast. They're probably cheaper, and they're also different kinds of outsourcing, I guess. Either way, they're growing a lot faster than IBM, so it's kind of interesting to me. I don't know a lot about the IT outsourcing markets, but we will learn more about it together, especially as we read and listen to other IT outsourcing companies like Infosys and Tata. Here's the graph that we just made for the euro. We'll talk about backlog and things like that later. Maybe next class. And see how cash flow and net income really track each other. Cool. They even have the prepared remarks written down. So you can just read them if you don't want to listen to them. I can almost hear it in this guy's monotone voice. It's often hard to run these really, really big businesses. Splitting up IBM could be another choice, but I'm not sure what you'd split it up into. They've spun off a lot of the businesses that aren't worth keeping. So that's enough on IBM. I think we've got a good hour and 45 minutes on IBM. Let's see if there's something else we could talk about for 15 minutes. Maybe some Q&A or... Let's see. There's a couple interesting... Oops.
Oh god, I hate hearing myself.
Maybe I'll just take Q&A from the Yahoo.
Any good questions? Yeah, so I have this idea. That, and we'll talk about a little bit about portfolio construction and things like that. So we try to build a portfolio. Yeah, the PowerPoint's in the. They're all in the PowerPoint's in there. So when you try to build a portfolio, one of the things the biggest thing is that very few people short sell or short. Most people are only long. In other words, they'll just buy securities instead of they bet that they go up instead of betting that they go down as well. And I actually think shorting is underused. One of the reasons is that you can't tell if the markets are going to go up or down. So just having longs means that you're going to not do very well if all stocks go down, and that happens quite a bit. In fact, the stock market hasn't gone up in many, many, many years. Let's see. This is the S&P 500, which I don't think is even the best thing to look at. You can see that from 02, let's pick, maybe 2000 to 2012, you would have not made a penny. You had a lot of stomach aches in between. Not a penny from 2000 to 2012. So it's very tricky. You'd much rather have a good rate of return than from 99 to 2012 have made no money whatsoever. Yeah, the market's finally up, but if you were just making money every year, you'd have doubled or tripled your money. So, and who knows if the market will stay up? Nobody knows. So I don't think the trend of the stock market is to go up, actually. I really don't. I think that's a fallacious argument. And even if you really believe that stocks go up over the long run, and that's net of inflation, right? Because there's inflation as well. So technically, I think, let's see. In fact, let's pull this up. The stock price of the S&P 500 tracking was 150 in 2010. And inflation is thought to be about 2% a year. So, 2000 to 2016, so this is 2000, May of 2000, the S&P 500 is $150. And it is 2016 right now. So the stock market has gone up less than 2% a year. Less than 2% a year. And inflation has gone up about 2% a year. So you're telling me stocks are as good as inflation, but they have all this risk that you don't need to take. That doesn't make sense to me. I'd much rather bet on I bet against overvalued stocks and bet on undervalued stocks. And I'll make a lot of money that way. Why do I have to guess the direction of the market? I'm not good at that. Very few people are good at that. But I can tell a dog when I see one. That's why I'm good at short selling. And I can tell a great company. I'll buy long when I see an undervalued stock like maybe IBM. And we looked at two stocks. We looked at Apple, which says that it's trading at 97. Let's say market price is 97, and our model price is 97. Then we looked at IBM, whose market price is 130, right? 137, and our model price is 210. Well, this is simple. If we do this, if there's a recession and we buy IBM stock price will go down, right? It'll go from 137 to like 127 or 117 or 107.
So if we're long IBM, we might be making a great investment. We'll still lose money if the stock market goes down. But if we're short Apple at the same time, and let's say there's a terrible recession scenario, because we haven't had one in 8 years, and they tend to happen every 10 years or so. Apple will go from 97 to, say, 77. So we'll make a lot of money on our short. We'll make $20 per share. And maybe, hopefully, IBM goes from 137 to only 127. So it'll still go down, but it'll be more resilient because it's such a cheap stock relative to the market price. It can't go down that much, whereas Apple could still be very undervalued. I mean, if IBM's 50% undervalued, Apple could be undervalued as well. So you could make $10 per share this way, even in a recession. That's why I like shorting. So the concept of the modeled price, or expected price, versus the market price, we can actually call that alpha. That's what it's called, alpha. Beta is the market movement. So when stocks go up, in like the S&P 500, all stocks tend to go up. And you can see IBM actually has a certain beta. It's a coefficient. You can actually add it up. Its beta is actually 0.7. IBM's beta is 0.7. So 70%, that means 70% of IBM stock movement is related to the stock market movement, whereas only 30% is related to IBM specific things. That's why the market is so important. That's why hedging out the market risk is, I think, a good idea, because you don't know what the market's going to do. And if you look at the last 15 years, the market hasn't gone up. It's gone up a tiny bit because of inflation. But if you adjust for inflation, it hasn't gone up at all. So I don't know why people think stocks go up over time. I think it's silly. There's no systematic reason why they should go up over time. In fact, I can tell you systematic reasons why they should go down over time. So, in any event. So the next thing that I talk about that's kind of interesting, and it's in terms of timing, how to time things. Well, let's talk about the second kind of elements first. My take is if you have 10 stocks, these are 10 stocks. My take on the stock market is that, and this is my experience over a long period of time, if you have 10 different stocks, on average, 8 will be fairly valued. In other words, the price you get from your modeled price, will basically be pretty close to the market price. And we saw that with Apple, right? We calculated, we did all these calculations, we spent all this time, did all this research, and the market price and the model price were both about $90-something a share. So that's fairly valued. There's no reason to buy or short Apple. I mean, it's basically trading where it should be trading. So 8 out of 10, on average, 8 out of 10, or 80%, will be fairly valued. 1 out of 10 will be cheap. In other words, the model price will be way higher than the market price. And 1 out of 10 will be very expensive, the other way around. The model price will be a lot less than the market price. I've been very good at this over the years, finding terrible drug companies to bet against. So maybe 1 will be cheap and 1 will be expensive. And you can't know which is which until you research all 10. And if you research all 10 and you think 7 of them are cheap, you got to ask yourself, how could I think 7 out of 10 stocks are really cheap and belong in my portfolio? That wouldn't make any sense. You know, this investing is like finding a diamond in the rough. You shouldn't be finding great bargains everywhere. You should be finding a bargain only every once in a while. Only every once in a while. So how do you find the bargains? I've mentioned, it could take you anywhere between 100 to 1,000 hours per stock. So if you want a portfolio, if only 2 out of 10 stocks are worth buying and shorting, this is assuming you do any shorting. If you don't, then it's 1 out of 10. If only 2 out of 10 are worth buying or shorting, and you want a portfolio of 20 stocks, right? You want a portfolio of 20 stocks. You need to do 100. You need to do 100 analyses. And since each one takes 100 hours at least, you're talking about 10,000 hours of work just to get the bare minimum work done to get a stock portfolio of 20 stocks. I don't know how many, let's see, 10,000 hours. Holy smokes. 10,000 hours. Let's see here. Let's say if I work 10 hours a day, and I work 300 days a year, it's about 3 years of work per year. I need 3 associates like Akil and Crystal and Coke Zero to help me. And that's working like a madman. Like a madman. So, do you still want to be an investor? It's not easy. And so finally, so you do those 100 hours of work. And that's for the bare minimum. And you want to be diversified as possible. We'll talk about diversification and concentration. But one of the things that people have asked about is, how long should I hold a stock? And I have this theory that as time goes to infinity, your ability to tell whether a stock is cheap or not, in other words, how much alpha is there, it should approach 1 or 100% or infinity or whatever you want to call it. You should be able to tell with certainty if a stock is cheap or not. If you had all the time in the world, you should be able to do that. The problem is you don't have all the time in the world. And even as you're researching a company, the markets will change. The markets will over time, markets will discover true value. And your arbitrage, or the alpha, will disappear. So you don't have time. Time is your enemy. Now as time goes to 0, in terms of a time frame, your ability to capture an arbitrage also approaches 0. So in other words, if you tried to day trade, let's say IBM, let's say today, IBM traded at 1540, it was $137.60. And at 1550, 10 minutes later, it was $137.80. And that is a totally random movement. There's no alpha in that. There's probably no beta in that either. It's just random. But there are people that try to make their living, especially computers, that try to make their living guessing on these very small movements. They buy and sell in milliseconds. I more or less buy or sell over time, over periods of years. But there are people that do that. And it doesn't work very well unless you're a computer. Computers tend to be very good at that. And a lot of people think computers are actually cheating. There's a lot of investigations about that at the moment. So that's sort of the theory of how I think about investing. There's a lot of other things. I kind of ran through that very quickly. So it's been about 2 hours. That's enough for me. I have to get back to some other things. So thank you so much for listening. I hope some of this was informative. We'll continue to look at a lot of the companies in the tech industry since people are interested in tech. We've done restaurants before. I've certainly done healthcare before. I'll be sticking around on the stream to keep discussing some of this stuff. But I'm going to turn it off for now, and I'll see you with lesson 5. Thank you so much, guys. I really appreciate you watching. Bye.